So again, thank you all for being here. This is actually a follow-up event from a lunch that we had with Patrick, about 2 weeks ago. And of course, this is with Durable's ETA chapter. So Durable, I'm sure you guys probably came here through Durable. If not, or if you're not familiar, Durable is here as basically the town square for small businesses here in Utah. Chase and I were talking a few months ago and realized that the ETA realm, so entrepreneurship through acquisition realm, really needed the same opportunity to have meetings, to get together and learn together and grow together. So we are pretty early on in the ETA chapter, and Patrick has actually volunteered his time to be a leader for us here. So thanks for doing that, Patrick. That's much appreciated. And so as you can see, we're here to convene the small business acquisition community. And through that, we'll do a bunch of events just like this one. So today, we've already been talking to him, but we have the one and only Patrick McMillan, the ETA professional, the EBITDA professional. He's over at Ampleo, and he's also, like I said, here a leader at Durable's ETA chapter. So thank you so much for being here, Patrick. With that, I'll stop sharing and I'll hand the mic over to you.
Nice. Pleasure. Well, thank you, Joe. Appreciate it. I love working with you and Chase. I've been a long time believer and you guys, what Chase is building, and super glad to be involved with you as well, Joe, and to be on the leadership team. So let's see. I'm going to share my screen. Make sure this will work. Okay, can y'all see he's at the right screen? Let's make sure. There we go. Perfect. And then arrange my screen so I can actually see you guys. Nice. Okay, so as Joe mentioned, I am, let me go ahead and advance to this next slide. A lot of people call me the QV guy. I actually even have, I call this my conference hat. So I made this. That's our Ampleo logo, QV guy on the front. On the back, I put adjusted EBITDA, and this is V1. We're actually working on version 2. We've got some renditions that we're working on, but it's not always just about EBITDA though. And so just some of the things I want to make sure we talk about today is what is important about numbers and why are they important, and what's also more important than the numbers. It's the story behind the numbers. So deals often fall apart, and a lot of people think, oh, it's because the numbers didn't fit. And yes, that's likely the case often. But it's interesting because you can see the same deal, and you see a few people pass on it, and you see a few people submit an LOI on it. Why is that? Well, a lot of times it's because, well, what are you going to do? How do the numbers fit? What's the story behind those numbers? So the deals don't always fall apart just because the numbers are bad. They often fall apart because people don't understand them or what they mean or how can they fit them in to their model. And so for me, when people ask, well, Patrick, what do you do? Well, besides, when you may start talking about EBITDA, right? I'm a storyteller. I tell the story about deals, about the numbers. What's the story behind those numbers? Why are they written in certain ways? Why are they fit in certain ways? You can have two of the exact same companies that can produce very different numbers for various reasons. And so, but let's kind of step back a little bit. I do want to talk about EBITDA for a minute. Let's talk about the numbers first. And then we're going to get into the story behind them. So EBITDA, earnings before interest, taxes, depreciation, and amortization. There are actually, there are 4 different types of EBITDA. And so as you guys are out there looking at deals to acquire, a lot of times you'll see, SDE or seller's discretionary earnings. Let me actually talk about that for a second, how that's compared with EBITDA. So seller's discretionary earnings, which are typically for smaller, sub $1 million revenue deals. And I see this quite a bit. I'm actually reviewing one right now that, the SIM talks about SDE. So seller's discretionary earnings are basically, you're going to add back one owner's salary. That's it. And maybe there is only one owner. Maybe there's a husband and wife team and there's two owners and they're both paying themselves, but you're only going to add one back. And that is SDE. Why are they doing it that way? They're basically just trying to say, hey, the new owner is going to pay themselves differently. That's it. Well, EBITDA takes it a step further. We're trying to normalize everything. So EBITDA as defined. Let me go back one slide. What do I mean as defined? If you take the net income of the company and you add back interest, taxes, depreciation, and amortization, those are 4 items you can pull directly off the income statement, directly off the profit and loss. And you add those back and you get EBITDA as defined. That's definitional. It's defined as that. You can't argue with that. It's right there in plain view. You can see that. But then the next level is what's called management adjusted EBITDA. For example, again, I'm working on a live deal right now, roughly about $1 million in earnings. It's a service-based deal. The seller and the broker have gotten together and said, okay, well, we're going to adjust a bunch of this travel because it's not related to the business. We're going to adjust a bunch of these dues and subscriptions because they're personal related. We're going to adjust X, Y, and Z, a few more things because they're the owner. So the sellers and the seller's representation, okay, broker or whoever it is they're involving, have gotten together and said, hey, we're going to adjust earnings. We're going to adjust EBITDA according to what we know is non-operating or non-recurring. Let's talk about those two things really quick. Non-operating. It's something that is not needed. It's an expense on the profit and loss that is not related to the company. For example, I'm going to take my family to Hawaii, but I'm going to use the business to pay for it. Why? Because I can justify it and I want to pay less in taxes. So I'm going to take my family to Hawaii. That's non-operating. It has nothing. If I completely did not use my business company to pay for my trip to Hawaii, the only thing that'll change in my business is I'll just have a little bit more cash. It's not going to change revenue. It's not going to change how the business is run. That's it. So that's non-operating. Non-recurring, let's say it's a one-time expense. Let's say my truck is owned by my business. Let's say, actually, here's a real example. I got my truck lifted. Okay. Well, first of all, that's non-operating. My truck doesn't need to be used to operate my business. But let's say it's our roofing company and I do use my truck, but I got my truck lifted and I used a business to pay for it because it's a business truck. I'm not going to get it lifted every single year. It's one time. It's a non-recurring thing. Another thing could be litigation. Now, hopefully your company is not very litigious. Hopefully it doesn't need, attorneys all the time, year over year. So typically if it's in, somehow if there's an employee lawsuit or something, that's a one-time event, typically. Okay. Now, again, I want to emphasize something. You've got to understand the story behind the numbers. I'm going to use that litigation as an example. Okay. Because maybe it's a one-time adjustment by management, by the seller, okay? But what if there's another pending employee lawsuit? Or what if something's coming up that may be a risk? And so if you're just taking things at face value and you're not asking a lot of questions and understanding those numbers, then that can really change the model. So, okay, management adjusted. That's what the seller and what management, current management, is adjusting to say, hey, here's how we feel like the business will actually operate. The next time of EBITDA, earnings before interest, taxes, depreciation, amortization, is diligence adjusted. That's where someone like me or my team or my firm will come in and say, okay, based upon what we've seen, based upon all the 2, 4, 6 hours or whatever of questions we've been asking, here's how adjustments we would make. Now, maybe that means some of those management adjustments, maybe we'll accept those, maybe we won't. Maybe we go back and reverse those out. again, live example right now. This is a service-based company. One of the things that they've adjusted is 100% of the vehicle expense. Now, I haven't had the discussions with them yet, but in my mind, I'm thinking service-based business. The owner is driving to lots of clients. And so why is he thinking he's adding back 100% of the business? 100% of the vehicle. He's probably thinking it's my personal vehicle. I'm not selling it with the business. And that's why he's made that management adjusted. But in my discussions I'm going to have with them, it's scheduled for Thursday. I'm going to be asking, okay, well, all of those $15,000 in 1 year of vehicle expenses, tell me where you're traveling. Tell me what you're doing in that travel. Tell me where you're going. Tell me how you're traveling to clients, things like that, because I want to understand how my client, the buyer, is probably going to also have the business pay for his travel. Maybe it'll be the same 15,000. Maybe it'll only be 5,000. Maybe it'll be 30,000. I don't know. So I guarantee you there's going to be some diligence adjusted numbers in there for vehicle travel, because I want to make sure I'm understanding what's the seller doing and what's the buyer doing, and I can make that appropriate adjustment. You see where you can't just take a number at face value without understanding the story. You've got to be able to understand what's happening, the story behind the numbers, so that you can make sure that that adjustment is representative of the business and the buyer. The last type of EBITDA is sometimes not even quantified, other considerations. And this has happened quite a bit. I shouldn't say quite a bit. It's happened often with like SBA. Because a lot of times there's something in there that I can't quite put a number to, but I know it's going to change. I'm trying to think of a good example and I can't right now. We'll probably will, hopefully in Q&A. But occasionally there are some things that I'm like, I know that this is going to change the business, but depending upon economic factors, depending upon, whatever's going on in the industry, that'll likely change. And SBA wants to know and understand that, but I can't quite quantify it. So I'll put that in other considerations. It's basically hey, I know something's going to change here, but I'm not quite sure how much. And so just consider this. That's why it's called other considerations. It's not part of the EBITDA number, but it's kind of hey, consider this as well. So what do I do, as a QV guy, quality of earnings, as a guy who really tries to understand the story? I'm looking, investigating quite often. I'm trying to make sure that I'm helping, the buyers understand what's happening. Now, when I do this, I don't always just do this for buyers. I will often also do this for sellers. I've done lots and lots and lots of sell site due diligence, sell site quality of earnings, help them prepare. I'm a CEPA, Certified Exit Planning Advisor, and so I can be able to go in and really help them, hopefully 2+ years in advance of a sale and say, hey, let's get your books in order. Let's get things cleaned up. Because when buyers come in and they're looking at a company, they're also wanting to see trends. And the longer the trend is, the more predictable it is, the less risky it is, which means you can be able to understand and hopefully even pay more and still get more out of the company. So you're trying to base things on predictability. Okay. You're trying to de-risk the company as much as possible. I have purposefully kept this short. This is, what happened when we did our lunch presentation a couple of weeks ago. We kept it short because I love involvement. I love making sure that we're answering, chatting through, some examples, some questions. I'm guessing that people here have seen deals, or seen, some things going on and hopefully have some questions. And so I would love to just stop the presentation there, and rather than being a lecture, let's have some conversation around these things. I know we have a small handful here, which is good and bad. It's bad because there may be some blank air. That's fine, but it's good because we can have some real good, solid, intimate discussions about hopefully some personal things that you guys have seen. So, Joe, we okay just kind of taking some questions from people?
Absolutely. Yeah, I love it.
Nice. What y'all got?
I got a quick question for you. First of all, thanks for the overview
Definitely
of
can.
the whole process. I guess like as the buyer, are there any common adjustments that sellers will make to their earnings that we should be particularly suspicious of, or like the most common things that we should be watching out for of like illegitimate add backs?
Yes, I like the word that you used there, Canon, suspicious. For me, yes, there are some hard and fast red flags, but again, my big thing is a lot of times sellers aren't trying to be malicious. Now, I didn't say all the time, but most of the time, they're not trying to be malicious. A lot of times they don't fully understand. So one of the things that I say happens quite often that I really want buyers to push on is exactly this example. So TM&E, travel, meals, and entertainment. So in this example I gave, where the sellers are adding back every single bit of the vehicle expense, ask questions. Okay, this is an asset sale. I understand you're not selling me the vehicle, but how am I, as a buyer, supposed to quantify my travel expense that I'm going to do in place of what you're doing? So that way you can try to figure out, okay, well, maybe I have a Tesla or an EV, and so that travel expense is going to be different versus their, V8 diesel truck, that's a 1976 and gets 6 miles per gallon, so that's one of the things that I ask a lot. The other thing, Canon, is about, and I'm going to go 2 different routes with this, paying people. Now, the first most important one, and we hear this all the time, okay, well, how much are you paying yourself as an owner? Okay, now, and I want you to be very informative about how this works, okay, and some financial people on here will understand this and some people will not, so please ask questions, okay. Are you paying yourself through a salary or a W-2 wage or something that hits the profit and loss? And what are you paying yourself? What are the benefits that you're getting? So in other words, how much, let's say you're paying yourself a W-2 wage, $100,000 W-2 wage. Okay, you got to factor in company paid taxes. You've got to also factor in insurance. You've got to factor in the payroll burden that's applied to that. Okay. But maybe you're also taking some distributions. So I'm going to give you a different example. Let's say you're paying yourself a very small salary, $45,000 a year, but you're taking $200,000 of distributions. Now, you as the buyer, and when I say you, I meant seller. Maybe the seller's paying themselves a $45,000 W-2 salary, but they're taking $200,000 of distributions, which hits the balance sheet. So their comp is definitely more than $45,000. So you as the buyer got to figure out, well, how am I going to pay myself? Maybe I'm going to pay myself a $100,000 wage. So you've got to make sure you're adjusting the income statements to be reflective of what's happening right now and what's going to happen. So that's owner compensation. Current owner, seller, and new owner, buyer, whether you're going to pay yourself or a general manager or something like that. Now, the second thing in wages, Canon, that a lot of people don't quite ask or miss, especially on smaller deals. When I say smaller, I mean, sub $5 million deals or even sub $1 million deals. What about key employees? So this live one I'm looking at right now, service base, there's 20 employees and 2 virtual assistants. And so I guarantee you a lot of our conversation Thursday is going to be around that. Tell me about the caregivers. What are they doing? How much are you paying them? Okay, what about insurance policies and things like that? What about the 2 virtual assistants? And we're going to try to figure out how we can relate that with what the buyer is going to do that's different. Who are the key employees? 20 employees, who's managing them? Is the owner managing them? Okay, well, how much time are you spending managing them? Is that a model that needs to change? And if so, how? And how are you going to pay a key employee or a manager or someone to manage that? So you've really got to ask a lot about compensation of the owner, compensation of current employees, key employees, and even along with that, 1099 versus W-2. We have an HR division. Ampleo has been around for 30 years. We have 6 divisions. One of them is an HR division, and a lot of what they do is 1099 versus W-2 compliance audits. Because I've seen a lot of companies get in trouble for that, us included. We've been there. One of our acquisitions we made years ago before we acquired them used to be a 1099 shop. They had to convert to a W-2 shop. One of my, about a month ago, acquisitions that I was doing a buy-side due diligence on had a lot of 1099 that had no business being 1099. I made a major adjustment to shift them to a W-2. So you've got to be able to ask questions like that a lot of times sellers and even brokers haven't thought through. Cannon, does that answer your questions? At least get close. Ask me a different way if it doesn't, please.
Oh, it's good. Yeah, that's super helpful. Thanks, Patrick.
Definitely. What else, guys?
Hey, Patrick, I've got a question for you.
Tyler, absolutely.
When would you say is the right time to do a quality of earnings on a deal to involve someone like you?
The second you sign LOI. And because the QV will change the dynamics of the business quicker than anything else. And so here's what's interesting. A few months ago, we changed our offering and how we do quality of earnings. So and Joe, I'll email. Actually, I think I've emailed this to you before. But I'll send it again if you want, so you can share it with everybody. But the way that we approach QV is a 3-phased approach. Phase 1 is red flags. It's not even a QV. So this is kind of components of financial due diligence. So red flags, we're going to spend about 2 or 3 hours or so with the seller and seller's representation. We're going to ask them like all these questions, things that I've been talking about. I've got a list, 13 pages. Now, I'm not going to go through every single question with them because it's kind of industry specific too. But I've got 13 pages of questions that I go through with the sellers. You know, talk to me about how you're doing this. How are you recognizing this? What is going on with this on your income statement? How about this on the balance sheet? What about deferred revenue? What about, that way? And we're going to, it takes about a week to do this. We charge $5,000 to do it. And when we're done, we're going to send you, the buyer, 2 to 3 pages of red flags. Here's what we've asked. Here's what we found out. And here's the key findings about that. This is how these particular items, 5, 8, 10, 12 items will directly affect your transaction. We're not going to adjust earnings, but we're going to ask a lot of questions. For example, the vehicles, okay, the employees, and we're going to give you, some language around a lot of those conversations so that you can understand what deeper conversations you might want to have with them. What does that give you? It gives you a go, no go, red light, green light, a push harder. And if you just still decide to go and you want more details, then we'll go to phase 2. Phase 2 is what we call validation or QV light. A lot of companies say it's a QV light. I don't care what you call it. It's a get the job done. We go in and we validate. We push on those red flags that we found. Okay, and then we will adjust earnings. We will produce net working capital. We will give you an Excel report with what adjusted EBITDA should look like. We're going to validate the earnings. We're going to go in and we're going to test a lot of those revenue items. We're going to test the costing. We're going to go in and we're going to do a cash proof of all of that. And then we're going to make sure that what they're representing truly is what's going on with the company. Takes about another week or 2 to do this phase 2, and we charge $5,000 to $7,000 for that. These 2 phases are perfect for the small ETA searcher space. We typically do those for sub $10 million revenue companies. We've done quite a few of them. Tyler, does that help? When? As soon as you sign LOI.
Right at the LOI. Yeah, that makes sense. And then for companies above 10 million, is there like a final phase that you do? What does that look like?
That's a full QFE. We charge $25,000 plus to do that. And a lot of companies will go straight into phase 3. We've done quite a few of those, especially for independent sponsors, private equity type deals, roll-ups, things like that. I've been involved in over 150 transactions. Most of those are a full Q of E. And for those, we deliver the whole shebang, the 25 to 50 page, PDF report. Here's what we've done. Here's our findings. Here's the adjustments. Here's how we validated them. It's a report that you can literally take to the bank, take to your investors, take to your sponsors and say, hey, here's the third party Q of E. How do you feel about this deal? By the way, when I say I've been involved in over 150 deals, I'm not counting 20 some years ago when I first moved to Utah and even bought and sold my own company in the real estate industry too. That's how I got started into Searcher when ETA wasn't even a word.
Desiree had a comment as well. I think brings up a great point of when did the last raise hit the employees and when is the next one coming? Have you seen many owners give their employees a raise on the way out the door or close to on the way out the door and kind of, yeah.
Yes, absolutely. Desiree, I love that you brought that up. Yes, I've seen that. And this is where it's frustrating because I've seen a lot of seller mentality. Basically, the mentality is, oh my gosh, I'm getting ready to sell this company. I've just now broken the news to my employees and they're going to walk. And so I'm like, hey, please don't walk. Let me give you this bonus. And that's where you've got to have between buyer and seller, you've got to have those conversations about that because Desiree, you bring up something. We've made 8 acquisitions at Ampleo in the last 18, 19 months. We actually just closed our 8th one last month. And that has happened often. So a lot of those conversations will even include some discussions around the purchase agreement, which will include, okay, certain amount of time prior to closing, salary's got to freeze, or you've got to call us, whenever you're getting ready to make a change, because that will change our model. We actually, at times, even on our own acquisitions, we will bring HR in to help with those conversations and discussions. Desiree, I'm actually going to take what you've asked and raise it one more level. A lot of the conversations, and Cannon, this goes back to your question, that buyers won't ask unless you involve someone like me, a QV guy, and say, okay, I see, live example right now, I see on the balance sheet, nothing about deferred payroll, nothing about deferred bonuses, or PTO that's accrued but not paid for. And so you've got to ask questions about that because a lot of times it's like, oh my gosh, I promised my guys a $100,000 bonus this December. Well, if I close in May and I haven't factored that in, there's $100,000 coming in a few months that I haven't factored into my net working capital. How am I going to fund that? I've even seen this to where companies have closed in November just to turn around and have to pay the bonus that was promised that wasn't discussed. And it killed their working capital. So yeah, you've got to be able to have, Desiree, I love that question. You've got to have those discussions about payroll, key employees, raises, when those happen, what's being deferred but not reported on the balance sheet, how does your payroll happen, things like that. Desiree, did that answer your question?
Yeah, it was more of a comment than a question. I've seen it happen so many times.
And Desiree, you're doing a webinar, is it or launching next week or in a couple of weeks?
26. It's on retention, but also on all of these things you get stuck in on the people side and the human side. And that's a big one. I mean, it's not just the financial. You've got all of these promises that somebody else made to somebody that you now either have to fulfill or be the total jerk about, right? Yeah. And it doesn't even give you wiggle room to be able to negotiate with them because you don't know where they're standing, when the last time they got a raise was, are they up for it? You don't get a chance to even give them kudos because if they just got a raise and a bonus, financially, it doesn't make sense to do it right again or set that precedence after coming on. And one of the least discussed things ever.
Yeah. And so I highly, highly encourage everybody on this call, and bring all your friends, please come to Desiree's discussion, because that is so vital. And Desiree, here's the other thing too, and I'm hoping you're going to talk about this. Not everybody's motivated by money. And it's interesting because I see companies give raises and give bonuses and they still see attrition, and it's like, you got to ask your employees what motivates you. My wife, not motivated by money at all. Not one bit. I mean, maybe 5%, but that's it. She took a cut to go to her current job and she's loving it. So,
well, it's something I've always told people, even if they tell you it's the money, it has nothing to do with the money. It has to do with what the money brings them.
Yeah, it's the security or whatever. Good point.
Mm-hmm.
Christian, let's hear it. Good to see you, brother. Glad you joined.
Good to see you. Thank you for the presentation. I guess one question that I have is this constant. I guess when you have this presentation or like an indication of interest, you ask before the LOI and you will agree to some sort of price or a range of price to buy that company. But then you do the QE once the LOI is done, and then you will have to go through all of this analysis to come up to, okay, this is actually a good number or not. But then, like, I guess, how do you come up with that initial offer? Or is that, maybe I'm wrong in the way that I'm thinking it, but like, I wouldn't like to go and say I want to offer this price and then we do the QOV and it's completely off. I'm like, oh, this doesn't make sense, right? So I guess, can you explain maybe more in detail on how that process works and how to come up with a better offer before doing the LOI and then go, or maybe I'm wrong in the process, so feel free to correct me.
Yeah, love this question. Let me restate it, Christian, because you were kind of breaking it out. I want to make sure I'm going to answer your question. So, and you're talking about kind of this sequence of events, IOI if you use that, LOI, then QV, then closing. And your question here is, hey, Patrick, how do I make sure that I'm basically penciling the right number in my LOI? Is that a good way?
Correct.
Okay.
Mm-hmm.
I actually had this discussion this weekend with my father-in-law, who's getting ready to, who's been trying to sell his company. So I'm going to share you a quick story to answer your question. So my father-in-law has been working on selling his company for a while. He's got a potential buyer that he met with a couple of weeks ago. They had some discussions. Discussions had nothing to do with numbers, not at all. They're both their competitors actually, and that's why they didn't have discussions about numbers. And so the company that my father-in-law had a discussion with walked away from the meeting, and the next steps were, well, we'll send you an LOI. And so when he told me that, I asked him, well, Dad, how are they going to know what to offer you? You guys discussed nothing about numbers. And he just had a blank face. I don't know. And so anyway, with his and my discussion, he actually agreed that he's going to send them some preliminary numbers. So Christian, the very typical thing, actually, I'm going to answer your question by an example that happened to me when I was a full-time CFO of a group of companies and we were growing through acquisitions. And this is literally what happened, no exaggeration. I was on a Monday morning, I would sit in my office. This is a conglomerate of companies. We were in 4 different industries. We had several different shareholders, 550 employees, 40 some different bank accounts. I don't even remember how many entities. The 2 owners, the chairman of the board and the president would walk in on a Monday morning, hand me a piece of paper and say, PMAC, we're buying XYZ business for XYZ price, and it's transferring tomorrow. We need you to, and I had to go in and get everything processed on that company. What they did over the weekend is they would sit down with sellers of the company that they were looking at, and they would just have very high level discussion. This is before I even knew what a QV was, right? They would have very high level discussions about revenue, margins, earnings, cash flow, balance sheet, shareholders, product, growth, all that stuff. They would sit down for hours with these guys and basically just say, okay, well, they knew my CEO and chairman, my president and chairman, knew how to kind of figure out, what they wanted right there. And so they would literally give them the offer, a verbal offer, and they would want me to pencil all the documents that weekend or that Monday morning. So Christian, in order to know how to make the right offer, you've got to know some high level numbers. Okay. What are they doing? Revenue, gross margin, earnings, and cash flow. Notice I've separated those because earnings are just a proxy for cash flow. You've got to know how you're going to finance the deal, because if you're going to use SBA or investors or a combo of the two, that'll change everything. I am going to share my screen. I've got this pulled up. I'm not going to spend a lot of time on this, but maybe I'll spend a couple of quick minutes. Before I share this, let me do this. Two things. Number one, I got this model I'm getting ready to share. I got it from someone else. So before the call, Chase and I were talking about SM Bash. Long story short, the guys that put on SM Bash, there's several different partners involved in there. They put this model together. They actually talked about this model at SM Bash. I love this model. I've used it for a while. But Christian, when you make an offer on a company, there has to be 4 people that end up being happy with your numbers. Okay. This is key. So whoever's taking notes, write this down. Number 1, the buyer, you have to be happy with the outcome. Number 2, your banker. The bank has to be happy. They have to feel comfortable that you're going to be able to pay off the debt, or at least make those debt payments. Number 3, the seller. They're not going to agree to the deal unless they're happy with the numbers. And number 4, an investor. If you are having to raise some of that money because you can't bring the full 5 or 10% down, then you have to raise the money. So those 4 people have to be happy. So Christian, when I advise people on making offers, this is the model that I use. And I'm just going to give you a couple of real quick ideas about it. We're definitely not going to have time to go in details. Purchase price. Let's say it's $1 million purchase price. Okay, actually, I can't change that because of the way that the financials are. So this makes sure that the seller is happy. Is the seller going to get what they want? Okay. Now, you also have to know how much money are you bringing down, okay, which is, it's modeled, I'm trying to remember where right now. Like I said, we're not going to have a ton of time. You have to raise some of the money here. You have to make sure that the person you're raising money from is happy with that. You have to make sure it's actually on, let's see, this one right here. Well, let's see, DSCR. So this is to make sure that your bank is happy. It has to hit the debt service coverage ratio. So you have to look at that and make sure that. So this right here, and there's some levers you can pull in an asset sale. There's step up, things like that. Or sorry, in any kind of sale in investors, there's step up, and you can basically tell your investor, hey, I know you're only going to bring in $300,000, which gives you a little bit of equity, but let me double that, your equity amount or something like that. So there's some different levers that you can use. So basically this right here is what I recommend using to kind of check the numbers. You basically will bring over some of the high level financials, do a little bit of high level adjustments and say, okay, this is what I think will happen. And then you're going to model it out. And then say, okay, I feel like I can offer the buyer $2.5 million I want to make sure that the buyer is going to bring in, some of the debt here. There we go. Maybe the seller's going to bring, 10% or even 20% sometimes. So just, different things that you can actually model out on here. Then once you know that the numbers pencil, that the numbers will fit all four of those parties, you can say, hey, seller, here's my LOI, $2.5 million purchase price, but I want you to fund 10% of the project. And then the rest of it's going to be cash, but they don't have to know that you're raising some of your cash from investors. Christian, does that long answer to a short question, does that help?
That's super helpful. Yeah, it makes sense. There's definitely more questions, but I think that will be a different session, but this is really helpful. Thank you.
That's one of those questions that has an answer that brings up 20 more questions.
Yeah. No, but this is great. Thank you so much.
Absolutely. Next, we still have a few more minutes. Joseph.
Okay, so you talked a little bit about recurring expenses. What framework do you use to decide whether it's a one-time expense or if management's just being optimistic about that?
Ask a million questions. Seriously. It's so dependent upon Joseph, the best question after you ask the seller the million questions to try to understand what that expense was, the question that you as the buyer need to ask yourself is, am I going to use this expense? Am I going to need to expense this again? If the answer is no, then great, adjust it. Okay, it's definitely a one-time. But if the answer is yes, I will need to do this again, especially in the first 12 months, then it's not an adjustment. It's not, it is reoccurring. It's something that will happen again. And if that's the case, then don't accept the adjustment. Just because the seller says it and just because the broker says it doesn't mean it's going to work for you. And maybe you, as one buyer, will do it one way, but Canon's going to do it a different way. And so that's the question is, what about you? Will you incur this expense again? Does that help?
Yeah, that's great. Thank you.
Nice. Give me another one, guys.
I think we got time for one more. And I got one, but I don't want to steal the thunder of someone else. All right. I'll ask it. So, coming from a few years working in real estate, the transaction itself is always a fluid sort of moving target. So, just thinking through this, I imagine you putting a company under LOI, say it's worth $500,000 according to the seller, and then you guys come in and really discover that the real money is at $400,000. So, what things can you discuss with the seller pre-LOI and maybe during that process to kind of educate them on that? And then do you have a general sense of how sellers react? I know that's a pretty broad question, but I guess just the question is revolving around how do you help increase your odds as you are going to potentially get a lower valuation to close the deal?
Love this question, Joe. And this is the question that everybody thinks of after the call, right? So thank you for asking. Two things that I will definitely frame even before, and again, my acquisitions were years ago, so I'm not currently acquiring, but when I advise some people acquiring, two things that I always advise to start the conversation around the framework, okay? First of all, net working capital, okay? That $500,000, what's that including as far as net working capital? Because a lot of sellers don't know that when they sell a company, when they sell a car, you have to leave some gas in there, okay? They think, well, I earned that cash. Yes, you as the owner earned the cash, but the business has to continue operating with X amount of cash. I actually just scheduled a post, I think it's for tomorrow, that you've got to remember, hey, what if you close on Tuesday and you got to make payroll on Friday? Okay, you've got to be able to fund that payroll. So first, and I know this isn't the direct answer to your question. But I'm going to get to the direct answer because it will involve this. Okay. So I'm always talking with the sellers about, hey, let's chat through networking capital, because I as a QV guy am quite often educating sellers and helping them to understand when you sell that company for 500,000, which may become 400,000, you've got to make sure it's got 20 grand or 50 grand or whatever it is in the bank on closing day. So that's the first discussion that I advise people to have even before you submit the LOI. Second thing, have the discussion of the what ifs. Okay. Hey, seller, I trust you. We trust each other, or maybe you don't. And the LOI, when I submit you the LOI, I'm going to submit that it says 500,000 because that's what you told me. But you and I both know that I'm going to hire a third-party person like Patrick to come in and do the due diligence. And I want to make sure and preempt this discussion. What if that diligence comes back different? Okay. I want to know that our relationship is good enough that I can come back to you and say, crap, man, you said 500. My QV guy said 400. Let's chat. Now, here's some things that you can chat about. Price versus terms. Maybe you still want 500,000. Awesome. I'll tell you what, I'll still give you 500,000, but I'm going to put the extra 100,000 that my QV guy found under. Will you be willing to do that in a forgivable seller note? And we're going to tie that to whatever the QV found. Okay. Maybe there's an issue in customer concentration. Maybe there's an issue in debt write-off. Maybe there's an issue in pending litigation or something. We're going to tie that forgivable seller note to those one or two items. That way, if in the next 12, 24, 36 months, those items are not concerning, great. The seller note, I will still pay it off. But if those do become issues, then we're going to put some provisions in there. Use your attorney, right, to write all that, to say, okay, well, that's going to be forgiven because I've got to be able to protect my risk, and the same as you. So your price, but my terms, or vice versa.
Makes
Does
a lot
that
of sense.
help answer? I'm a manage expectations guy. That's my favorite phrase, especially in the last year or so. My favorite phrase is manage expectations. Have the uncomfortable conversations. The sooner you have them, you're going to lay everything out on the table and you're going to talk about it.
Yeah, that's awesome. I appreciate that, Patrick.
Absolutely.
And it looks like we're, of course, and we're just about up on time, so I want to make sure to be respectful to everyone's schedule here. But man, thanks so much for sharing all your thoughts and wisdom on this stuff, Patrick. I know it was certainly helpful for me and hopefully helpful for the rest of the people on the call here. And thank you all for being here. Sorry for the technical difficulties at first, but we'll get that hashed away. Don't worry, Desiree. We'll have that one handled. And I appreciate you bearing with us, Patrick. But just a few quick announcements on the ETA side. We'd love to have y'all in our durable community as we continue to build momentum here. We're extremely excited for what we're building, and we're excited to have y'all here. So I'll leave this up for just another sec if anyone wants to grab that real quick, and I'll send a follow-up with this as well. A couple next events, we'll have Desiree, as you mentioned, Patrick, with a lunch on the 26th and then a webinar on the 9th. And then we'll actually have SMB Law coming and talking on a webinar, and then Ryan at Live Oak Bank at a lunch here in June. So excited for the next couple events we have. And sincerely, thank you so much, Patrick, for taking the time to do this. And any closing thoughts from your end, Patrick? I realize I didn't really give you the floor to wrap up. I apologize.
No, you're totally good. I feel like I wrapped up. I put my LinkedIn link, in there. Please reach out to me. I'm happy to always just jump on that quick call, and say, hey, let me just run something through your filter and see how it goes. Happy to do that.
Awesome. Patrick is a great follow on LinkedIn. A great connection. He's always posting interesting stuff. So, well, thanks again, everybody. And like I said, I'll send a follow-up with the notes that Patrick mentioned and some next events we have coming up, and look forward to seeing you at the next event. We'll talk to y'all soon.